Shortly after hearing about real estate syndications and learning how simple it is to generate passive income, you might start wondering, but what about taxes? Hi, I'm Arden Cinedello with Spark Investment Group, and I'm so glad that you're watching right now because you're about to see how easy it really is to reap the rewards of the tax benefits associated with real estate syndications. You work hard to produce income to provide for your family and your future. Paying taxes is a civic responsibility, but for many, taxes is a huge expense taken out of their income. I would like to show you how you can legally reduce your tax bill through the deductions available to real estate investors. When you invest in a real estate syndication, the first thing to know is that every year you'll get what's called a Schedule K-1 to file with your tax return. This typically comes near the end of spring. Basically, a K-1 statement reports your income and losses for that real estate syndication investment. Now, one of the biggest benefits to investing in real estate is that you can write off the expenses. In commercial real estate, which are these real estate syndications I've been sharing about, you have two main benefits, which include depreciation and cost segregation. If you own a small rental house, you're probably familiar with depreciation, which means that you can write off the value of an asset over time. With residential real estate, that's 27.5 years. If you buy a small rental property, you could write it off a little bit every year for 27.5 years. Based on a depreciation schedule of 27.5 years, an investor can only write off about 3.6% of the improvement value of the asset each year. It's not a large amount. Syndications are typically only held for 5 to 7 years. Over this time period, the tax benefits from depreciation would be relatively small. This is where cost segregation comes into play with apartment syndications. With cost segregation, when we buy these apartment buildings, we will have a cost segregation specialist come out to the property. They will create a report that will say, all lighting fixtures can be written off over 10 years. The carpets you can write off over 5 years, and so on and so forth. Suddenly we have a schedule that allows us to write off all of these different pieces over a much more shorter time period through bonus depreciation, which will allow the full write-off of all components with a life expectancy of 15 years or less. That increases the amount in write-offs we can take up front during these first 5 or 6 years. That's a portion of what the sponsors are handling in the background, and you will see these losses reflected in your K-1s each spring. I think one of the coolest parts about investing in syndications is the cash flow returns every month or quarter, but when you get your K-1 in the spring, it won't show that you actually made money, it'll show that you lost money because all of those depreciation and cost segregation benefits. While you are actually cashing checks and putting money in the bank, on paper it looks like you're actually losing money. Now I know this can be confusing, but for tax purposes, it's a really good thing. That means you are likely not going to have to pay any taxes on that cash flow income. Now, as for the rest of the losses, because sometimes those losses can be quite substantial, you'll have to talk to your own CPA about how that applies to your particular tax situation and how much of those losses you can actually apply, if any, to your ordinary income. I want to make sure you hear this. It's likely your ongoing cash flow will not be tax-free, but tax deferred. You will not have to pay any taxes on it right now, but when the asset is sold at the end of 5 years, let's say, there will be a depreciation recapture, and you will have to pay taxes on the gain. Again, your CPA is the best source of detailed information on this. Talk to your CPA and see how this will apply to your personal tax situation, because your tax situation and my tax situation are going to be different. All in all, that's what you can expect from investing in a real estate syndication. A K1 each spring and paper losses throughout the life cycle of the project. A lot of big financial decisions take place through the process of finding a syndication investment deal. So if you've invested in a syndication, what were some of the biggest tax benefits you found from this investment? And if you haven't yet invested in a real estate syndication, what's holding you back? Love to read your comments. If you're interested in learning how investing in real estate syndications can help you achieve financial freedom and live the life you've always wanted, I'm personally inviting you to join the Spark Investor Club today. You'll find the link down below in the description. In closing, please give this video a thumbs up and make sure you're subscribed so you can get notified when I post further videos. Do you have a friend who needs to hear any of this information? Please share it with them. I'm Arn Cinedella with Spark Investment Group. See you next time.